Welcome to the Daily Consolidation, your essential daily briefing on Wall Street's most important moves, bringing you the market insights that matter, delivered right after the closing bell. Please note the views and trade ideas shared on this podcast are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in.
Okay, so today, October 21st, 2025.
Wow.
This was one of those days I think people will look back on, maybe months from now, when they try to figure out exactly when the market regime really shifted.
Right.
Because if you just glanced at the headline numbers, you'd think, oh, quiet Monday, S&P 500 up just, 0.13%, closed at 6,744.
Barely moved on the surface.
Exactly. But that number is, frankly, a massive lie. Underneath that calm surface, we saw just this incredibly violent rotation of capital.
Yeah.
And at the same time, a historic collapse in defensive assets. That's really the core story today, isn't it? It defines everything. We're not just calling this some, moderate shift. This felt like risk-on rotation with haven asset capitulation.
Capitulation is the word.
Absolutely. What we saw was the market basically throwing off its defensive stance.
Yeah.
All that geopolitical insurance people were holding, gone in one dramatic session.
Yeah.
The shift was, it was absolute. Money just poured out of those fear trades and straight into the productive cyclical parts of the economy. It forced this huge instantaneous realignment of risk appetite. And for you, the listener, this isn't just market noise. It really signals a structural change in what investors are actually demanding right now.
Okay, let's dig into that. Segment 1, the quality to cyclicals power shift. I mean, the clearest proof of this rotation is just looking at what led the market, right? While the S&P was basically flat, the Dow Jones Industrial Average just powered ahead.
Yeah.
Straight through to new record territory, closed at 46,707. That's pretty stunning.
It really is. And contrast that with the NASDAQ, which significantly underperformed.
Right. So it's the old economy basically schooling the tech sector, showing who has the real cash flow and operational leverage right now.
I think that's exactly it. It feels like the moment where investors kind of stop chasing that future promise of disruptive tech, which, let's face it, has been the dominant theme for so long.
For years.
Yeah, and started prioritizing the tangible profits of today.
Yeah.
You look at the Dow, it's packed with industrial giants, companies that move real stuff. That leadership speaks volumes. The market's basically screaming, show me the cash flow now, not 5 years down the road.
And the absolute poster child for this whole idea, the one stock that just perfectly captures this power shift, has got to be General Motors.
Oh, GM's performance today was genuinely stunning. The stock surged more than 15%. 15%.
Incredible.
After just crushing its Q3 expectations. I mean, think about these numbers.
Yeah.
They posted $2.80 in adjusted EPS. The street was looking for what, $2.31?
That's a huge beat.
A massive beat. But honestly, the guidance, that's the real story here.
Right. Tell us about that guidance update. Why is raising the full year EBIT guidance to $12 billion to $13 billion so important in this context of a rotation?
Because it validates that whole transition we're talking about from just narrative to actual reality. For the last few years, right, the market rewarded EV potential, pretty much regardless of whether that part of the business was making money. GM seems to have navigated that really tricky balance. This guidance raise proves they've got real pricing power. They've mastered operational leverage, meaning, they can make more money without massively increasing costs.
Yeah.
And crucially, their legacy business is just throwing off tremendous amounts of cash. This is like the textbook definition of quality within a cyclical sector, and the market is rewarding it violently. It shows investors will pay up for certainty, especially when the macro picture is, uncertain.
And it wasn't just GM or auto manufacturing, was it? We saw other related sectors getting a lift too.
Oh, absolutely. A rising tide lifted all those, let's call them mature ships today. The KRE Regional Bank ETF, for example, climbed about 3%.
Okay.
That's a direct signal, I think, that those fears about regional bank health, remember all that noise earlier this year?
Oh, yeah. Felt like a long time ago now.
Right. Those fears seem to be rapidly fading. When banks rise alongside industrials, it's like confirmation that the market believes the underlying economy is pretty stable. And the companies that need financing, that need stable supply chains, they're seen as being positioned to succeed. It's the market rewarding maturity over pure speculation.
Okay, so that's the risk-on side. If the rotation into cyclicals was the positive vote for risk appetite, then the collapse in safe havens was the negative confirmation. We absolutely have to talk about this great unwind in precious metals. It was genuinely historic today. This wasn't just a dip. This was A wipeout.
A volatility spike like we haven't seen in, what, over a decade? Gold fell 5.79%, down to $4,105.55. That is the single worst day for gold since 2013.
Wow.
And silver, being less liquid, it got hit even harder, down 7.39%.
And you have to appreciate the whiplash here, right? Gold hit an all-time high just yesterday, October 20th, $4,371.78.
Exactly. To fall off a cliff like that from a record high, that isn't just profit-taking. That feels like a full-scale capitulation of fear.
So what triggered it? Why now? It seemed like geopolitical tensions, especially around trade, were the main fuel pushing gold past $4,300. Did all that just disappear overnight?
Well, they didn't exactly vanish, no. But the market's perception of the immediate risk, that collapsed. Think of geopolitical fear like compound interest. It builds up slowly over weeks, months maybe, creates this massive fear premium that investors are willing to pay for safety.
Okay.
When the main reason for that fear gets suddenly dialed back, that premium just evaporates almost instantly.
And the dialing back came from President Trump's comments today.
Precisely. The main catalyst was President Trump expressing, well, noticeable and pretty unexpected optimism about the upcoming trade talks with China. And maybe more importantly, he stated clear plans to actually visit early next year. Now, this felt like more than just the usual political noise. It gave institutional players some conviction that those highly feared 155% tariffs,
The big tail risk.
the major tail risk driving gold, were now firmly off the table, at least for the immediate future. When that massive uncertainty that was priced into gold suddenly gets a timeline and a sort of optimistic framework around it, well, those highly leveraged fear trades are forced to liquidate instantly. And that's how you get a 2013 level crash.
It really shows the asymmetry of pricing fear, doesn't it? It takes ages to build up that premium,
Right.
but one signal can wipe it out in minutes.
Exactly. We should stress, though, the risk hasn't completely gone away. Trump still holds out that threat of 155% tariffs if a deal isn't reached. It's a powerful negotiating tool, right?
Sure.
So the risk has been dramatically lowered and crucially postponed, not eliminated. But the market is definitely celebrating the delay today.
Okay, let's pivot now to what we're calling Divergence 1, Bitcoin. Selling off hard right into all this equity strength.
Yeah, that's weird, isn't it?
It is. If the market is genuinely in a risk-on mood, if fear is really receding like the gold market suggests, you'd expect Bitcoin to be participating, maybe even leading.
Right. High beta asset.
Exactly. Yet it fell nearly 3% today, settling around $107,000. It just completely failed to track the broader market rally. What's driving this decoupling?
This divergence, I think, is rooted entirely in conviction, or maybe the lack of it, among institutional players. Bitcoin broke below a really crucial technical level today. The 200-day exponential moving average, that was hovering near $109,500.
Okay, the 200-day EMA, important for trend followers.
Hugely important. For long-term trend followers, for major institutional funds, the 200-day EMA is often that technical line in the sand. Breaching it, that's a sell signal for many because it suggests the longer-term uptrend might be broken.
So the technical traders are selling. But are we seeing hard evidence that the big money, the institutions, are actually pulling funds out physically?
Oh, we are seeing overwhelming evidence. The institutional flows are probably the most worrying sign for Bitcoin right now. Bitcoin ETFs recorded, get this, $40.47 million in net outflows yesterday, October 20th.
Okay.
And that marked the fourth consecutive day of redemptions.
4 days straight.
4 days straight. And the scale is what really matters here. Since October 17th, the total withdrawals from Bitcoin institutional products now exceed $1 billion.
$1 billion out.
$1 billion out. BlackRock's IBIT, just one example, saw over $100 million in outflows itself yesterday. That is institutional money basically saying, okay, we rode the rally up, we maybe hit our targets near $126,000, and now we are heading for the exits.
$1 billion in outflows over just 4 trading days is, well, it's significant. It suggests maybe institutional patience has worn thin, especially when the asset just isn't rallying alongside stocks like this.
It signals deteriorating conviction, absolutely. Institutions often view crypto as a high beta risk asset, right? Something that should perform spectacularly when the overall market is feeling good.
Yeah.
When it fails to do that, they seem quick to redeploy that capital into sectors that are working, like those industrials we were just talking about.
Makes sense.
So for anyone holding crypto, the failure to hold that $107,000 to $108,000 support zone now looks critical. If that support breaks decisively, well, the next big psychological level is $100,000.
The big 100.
Yep. And a break below that could easily trigger a fresh wave of pretty aggressive selling, I think.
Okay, something to watch very closely. Let's move on to our second major anomaly today, divergence 2. Treasuries, just refusing to sell off.
This is the most counterintuitive piece of the puzzle today, isn't it?
It really is. If the market is ditching fear, look at gold collapsing and embracing risk, look at cyclicals, soaring bond yields, which usually move inversely to bond prices, should be spiking dramatically.
You'd expect them to rise, yeah.
But the 10-year Treasury yield held remarkably steady. End of the day barely changed at 3.99%. What explains this profound calm in what's supposed to be the safest market in the world?
It really feels like the Federal Reserve's heavy hand is acting as an anchor here. Despite all these shifting winds of risk appetite and trade optimism, the bond market seems to be ignoring pretty much everything else because it's almost certain of one thing. A Fed rate cut is coming.
How certain are we talking? Like, what are the odds priced in?
Right now, the market is pricing in nearly 100% probability of an October Fed rate cut.
Wow, 100%.
So much baked in. And that expectation acts like this huge gravitational force, just anchoring yields, especially on the short and intermediate parts of the curve. The smart money in the bond market seems to have decided that the biggest driver for the future price of money isn't the latest geopolitical headline or some earnings report. It's the Fed.
Right.
They are leaning heavily on the central bank to deliver that cut. And until that expectation gets shattered somehow, the 10-year yield looks kind of stuck near 4%.
Okay, that anchoring leads us perfectly into the immediate risks on the calendar then, because we have two major data points coming up that could either, validate today's rotation or potentially unwind it violently, all in the next 72 hours or so.
Yeah, we really need to stress that today's relative calm, especially in bonds, feels fragile. First up, we've got tech earnings. Netflix reports tonight. Tesla reports tomorrow.
Big ones.
Huge ones. They serve as critical litmus tests for those high valuations across the entire tech sector. If either of them significantly misses expectations, or maybe guides lower, the whole NASDAQ rally we've seen over the last few weeks could face enormous pressure.
But the single biggest item on the risk monitor, the one everyone's waiting for, has to be the Consumer Price Index report on Friday, October 24th.
That is absolutely the make-or-break moment for the market this week. Remember, the bond market is pricing in 100% chance of a Fed cut. That requires inflation to stay, benign.
Under control.
Exactly.
Yeah.
If Friday's CPI report, remember, it's the delayed measure of inflation, if that comes in hot, that certainty is instantly destroyed.
Right.
It would force a violent repricing in bond yields. You could see the 10-year yield spike, which raises borrowing costs everywhere.
Undermining the equity rally.
And, in turn, likely unwinds a lot of today's gains in risk assets. The market is currently priced for perfection on inflation. Any negative surprise there could be, catastrophic for current positioning.
Okay, so if we try to synthesize all this rotational energy, the geopolitical unwinding, these divergences, and the immediate risks, what are the most actionable themes right now for you, the listener, heading into the rest of this week?
Well, I think the conviction themes flow pretty directly from today's action. The market is unequivocally rewarding tangible profitability right now.
Okay.
So that means we remain long industrial and manufacturing companies that have proven pricing power. That feels like a high conviction call, directly backed up by results like GM's today. On the defensive side, given the gold collapse, we'd recommend a tactical short on that precious metals rally, maybe targeting a swift retest of the $4,000 level for gold, just acknowledging that the geopolitical risk premium has basically evaporated for now.
And what about those two divergent sectors we highlighted, Bitcoin and big tech?
For Bitcoin, look, those institutional outflows are just too significant to ignore right now. So we'd maintain a tactical short view, probably using defined risk strategies like put spreads, but specifically respecting that critical $100K level as a potential test zone. The institutions have kind of spoken with their feet there.
Okay.
And finally, on technology megacaps, we'd stay neutral. With Netflix and Tesla reporting literally tonight and tomorrow, there's just too much binary risk. Better to wait for the dust to settle after earnings, maybe find better, safer entry points once the valuations consolidate a bit.
So, summing it up, today really feels like confirmation of a decisive regime shift towards cyclical quality. The market is becoming increasingly bifurcated, isn't it? Separating those industrial cash generators from the more narrative-driven, longer duration names.
Absolutely. And that separation brings us right back to maybe the most fascinating anomaly of the day. The resilience of that 10-year Treasury yield.
Yeah.
The fact that the yield didn't spike, despite this aggressive risk-on mood elsewhere, tells you that some very smart money is still holding on to the belief that the Fed will be forced to act. But here's the flip side, the provocative thought perhaps. Maybe they're betting on a surprise. So consider the implications if Friday's CPI report actually proves those bond traders right about underlying inflation pressures, forcing the Fed to seriously reconsider that expected October cut. That could send ripples through absolutely every corner of the market.
A lot riding on Friday. Okay. That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe, and we'll see you at the next close.